Exciting times. It looks like I'm getting you're live. And I am Lacey Filipich. I am here on behalf of Women in Technology WA, which is an organisation that I volunteer for. And I am the awards lead on that organisation. And for those I haven't met before, hi. But the reason that I'm specifically here today is to talk to you about personal finance stuff. So this is a bit experimental. This is our first time doing a YouTube live version of this. We did a Facebook live version last week with Greece DNA, which is fantastic. But we thought we'd try YouTube because we've got the YouTube channel and see how it went. So I'm the lucky guinea pig. So hopefully it all works. I'll do a little bit of housekeeping first. There is a chat function here. Now, I am terrible at processing while I'm talking. So what I would suggest you do is if you have a question that you'd like to ask me, I will aim to get to that at the end. You can type that into the comment section if that's live. You feel free to write your questions there. When we get to the end, I will, or if I lose my track, I will look across at those questions and try and answer them. And we'll see how we go with that. And of course, this is recorded. So if you miss anything, if it drops out, anything like that, you'll be able to watch this again later. So apologies if that does happen. I've got my mobile hotspot on because that's the best source of data and told my children not to use it. So hopefully we should be okay, but we'll see how it goes. So the next thing I have to tell you is, of course, that this is not financial advice. This session is not supposed to be me telling you what to do with your money because I'm not qualified to. I am not a financial advisor. I don't operate under a financial services license. I'm a financial educator. So what I'm going to go through today is some general stuff, some things to think about. And because this is such an uncertain time, because we don't know what's going to happen, it's going to be something that you're going to have to apply to your personal situation and as things change. The high-level overview of what I plan to go through today is, first of all, a bit of a what's the current economy doing, bit of context, why this is important for women. Now, everything I'm going to go through from a monetary perspective is genderless. It doesn't matter whether you're a man or a woman or anything in between or alternative. You are able to do all the things that I implement. It will have the same impact for you. But I do want to touch a little bit on why it's important for women to be thinking about this stuff because, of course, we are about women in technology and this is a mainly female membership. So I did want to touch on that and why it's important. I'm then going to go through two chunks. The first chunk is going to be what to do if your income's dropped. So let's say you've lost your job or it's diminished greatly. What do you do in that circumstance? So we'll go through a few things that you can think about them. And then the second chunk we'll go through is what if you haven't had your income drop? What if you still have a job? What if you're feeling secure? What are some things you should be thinking about now? And what are some opportunities that there might be out there for you? So that's what we're going to run through. We'll start off with what the economy is currently doing. Now, the economy is an interesting beast. It's a machine, if you like. And there's a great video that I'll post a link to called How the Economic Machine Works by Ray Dalio. It's a great little animation. If you're not comfortable with economics, it is worth watching this video. And the reason for that is you need to have a bit of understanding about the economy to understand what's going to be happening over the next few months. Otherwise, the stuff that you're going to see in the news is just going to sound like gobbledygook. The great news is it's nowhere near as complicated as people make it out to be. It is actually quite straightforward, and that animation is a great way to get the grounding. The high-level moral of the story is a typical economic cycle would be 5 to 8 years. Now, we talk about a cycle as being from, boom to boom or from recession to recession. So we go through this, the economy's growing, it's great, it hits this peak. Oh, no, we're having a contraction, it drops down. Then we have a recession, and that's when everybody's miserable and unemployment is, and then, hey, it gets better again. So the point from X to Y at any of those points is considered a cycle. A cycle would typically be 5 to 8 years in a developed economy. And that is based on, 100 odd years of research now and of us operating with share markets and our capitalist societies. So it's been pretty reliable. However, Australia has been pretty unique. We've had, I think it's 28 years of a growth cycle. So instead of an 8-year cycle, we've had 28 years. So we've dodged that recession for a very long time. We haven't had a contraction. And lucky us, right? That's fantastic news, but it is really weird. It's very unusual. And so that means that I think we were already seeing signs of this. We had some very slow growth in 2019. We had one quarter where I think it was 0% inflation. There was already some signs of economic slowdown. Now, what we're seeing now, of course, is a very dramatic slowdown. And this is hypothesized, if you look at Ray Dalio's video, as being part of the super cycle. So this cycle of going, we go from peak to trough to peak to trough to peak to trough, and it always trends up. That has been the typical experience that we would hope to see continuing. But overlaid with that is this long-term debt cycle. So there's this idea that our debt gets too high, that we end up eventually at an unsustainable level. And then we've got to look at alternatives for ways to reduce that debt to be able to keep the economy going, because we can't continue to service the loans that we've given ourselves. And in Australia, when we talk about the size of our economy, it's something like 65% debt. It's imaginary. It's ones and zeros on our computers. So it's a big deal. And when you start to hear over the next few months, there's stuff about monetary policy, which is where we change our interest rates to try and control inflation. There's stuff called quantitative easing, which is basically printing money. There's all these fantastic tools that the government is using, buying bonds from themselves to finance many hundreds of billions of dollars of worth of packages. And of course, there's things like debt write-downs that we might expect to see. So I would recommend that you go and watch that video. And Dalio's hypothesis is that we are going through one of these super cycles. And we haven't seen one because they run every 50 to 75 years. Of course, we haven't seen one since the Great Depression, which was the 1930s, 1930 to 33. So it's a very interesting economic analysis, and it's no surprise to any of us that there aren't many people in your lives at the moment who have probably lived through something like that, because all the people who lived through the Depression are well into their 80s, 90s and past. So you're probably not going to be able to talk to someone and go like, oh, yeah, I know exactly what it was like and it's familiar, though you will probably be thinking back to those stories that you might have heard from your grandparents during wartime, where they saved everything and they, reserved the dripping for their bread and sugar was scarce and you painted on your stockings with gravy and things like that. Now, the question now, of course, is what's going to happen next? Are we going to see something called a V-shaped recovery? So this is this idea that, we're going to hit this bottom and really quickly bounce back, and it'll all be fine and we'll turn all the industry on and we'll all be good. So there's that question. Are we going to see a U-shape, which is this idea that we're going to drop down, and we have dropped quite fast, and are we going to stay like you would in a typical recession for a while and then it will recover slowly? Or are we going to have the dreaded L, which is this, hey, we've had a drop and hey, we're not going to go up quickly. We're just going to keep tracking along. No one knows. I'll just consult my crystal ball, shall I? Let's have a look. What are we going to do? Are we going to be a V, a U, or an L? Not working. Sorry. No one's got a crystal ball for this. And no one really knows. There's a lot of people who are guessing. There's a lot of people who are hypothesizing. But this circumstance that we're going through, where we've got the coronavirus, something that does not have a vaccine, doesn't have a clear cure yet, and it's basically locking down industries in massive proportions. We haven't seen that happen before in our economic modelling anywhere, really. The last time we had, and people liken Spanish influenza to what we've gone through now, and it's the similarity is in the spread. Okay, it's not necessarily in the dynamics of the virus. I'm not talking about it in terms of what type of illness it is. I'm talking about the impact that it had and the infection rates. That happened in 1918, right? And that is a long time before the Depression happened, 11-year gap before Black October 1929. So we don't really have a model for when these two things coincide. And we've got some other extraordinary things happening at play at the moment, of course, that are an impact of this. For example, you might have seen oil prices went to negative $35 a barrel last week, which is pretty extraordinary. I would never have guessed that would happen. But the buyers have to be paid for storage because we're full. We can't process anymore. You can't turn off an oil well. So that's quite interesting. So we've got all these things happening that we don't know what's going to happen. We can't say with certainty, oh, yes, it's going to all be fine in a year's time, or no, this recession's going to last 2 years, or no, this is a massive readjustment. No one really knows. The further along we go, the more confident we can be, but we don't have an answer. So my suggestion, if you're looking for an answer, is give yourself a break and don't look for an answer, because everyone is guessing. With that in mind, we don't know what's going to happen in the broader picture. So we have to play defensive quite quickly rather than waiting to see how it pans out. That's my personal opinion. And the reason why this is really important for women is, of course, we start with a gender pay gap and a gender retirement gap. Now, there will be people who love to jump on this and say there is no gender retirement gap and there is no gender pay gap. Look, there is, in my opinion, having looked at the data, and I will take the majority on this, the same way that we can argue about any kind of thing with alternative studies. Women, on average, get paid less for the equivalent work. So we start behind the 8 ball already. We retire with 28% less super, and that's for the women who do retire with some super. In WA at the moment, we've got 1 in 3 women retiring with no super. There are some pretty significant impacts because of our gender, and it gets called a vagina tax. Not terribly polite, I know, but it's true. It is a bit of a vagina tax. So the reason why women especially have to be thinking about this is because we have on average less pay and on average less resources to draw from. So being a woman just means you've got to be that much more onto it. Now, it's a big reason why I support Women in Technology WA. We champion careers in the science, maths, technology, engineering space. We try to get women into those kinds of roles and encourage students to keep studying STEM so they can get into those roles. And the reason for that is they're higher paid roles. That's personally why I'm a big advocate for this. And I'm a chemical engineer, I've certainly seen that those kinds of degrees, those kinds of experience, those kinds of careers have on average higher pay. So that's why it's important for Women in Technology WA's mission, but it is also important in context of your finances to be thinking about how much you're earning and making sure that you are doing the most you can with your skills. So being a woman isn't about, oh, it's too hard for me. It isn't, oh, this sucks, or, I'm never going to be able to get there. It's just about realizing that we have fewer resources on average and we have less super on average. And therefore, what can you do to make sure that you do it really well so that you get through this financially without ending up in serious strife? Okay, so if that didn't motivate you already, I hope that helps you as a woman to think about what you're going to do and to get excited about being proactive on your money. The chunks we're going to go through next, as I said, we'll do it in two parts. First one we'll deal with is what if your income has suddenly dropped? Now, your income might have dropped because your industry shut down. There were industries that have been made illegal, people working in events, then restaurants have been closed down, lots of people who run small businesses, anyone who had face-to-face or gathering experiences, anyone in travel. Man, the list of industries that this has impacted is exceptionally large. And because of that, a lot of people have seen flow-on effects for their income. So if you were in a business that serviced those industries, you might have seen a hit to your income. And obviously there's lots of people who have either just woken up one morning and had no job, or they've seen 20% reduction in their income as a business, or their bosses have asked them to take a 50% pay cut. Now, the government is doing a fantastic job trying to get as much support to those businesses and those people as possible. They've increased the amount of money that they're paying to job seekers. So they've added a $550 a fortnight supplement to that. They've got the job keeper allowance, which is allowing businesses to hibernate, this idea that you get to pay your staff some money so they don't go off and get other jobs. They can survive, but when you're ready to restart the business, they'll be there. Those kinds of things are being done to try and get everybody into a situation where they have at least enough money to survive while we go through this period, however long this period might be. And we don't know how long it's going to be, right? Very cautious retraction is what we can probably expect to see of a lot of these restrictions. And rightly so, right? Because there's a massive health impact on this. But it does mean that there are people out there who have suddenly found themselves with a lot less income. And there are people who don't meet the criteria for any of those packages. So there are people like international students. There are people like self-funded retirees who are not going to be receiving anything from that government payout. So those people as well have an extra imperative if they've seen their income drop. And it's about really, for the next period, trying to get through without selling assets if you can do it, and with as little debt as possible if you can manage it. That's what I think the aim is if you've seen your income drop. And until we can get to a period where you've got your income back again, at least to a similar level, you've got to think defensively about how you can try and get your costs down. Because when your income drops, of course, money going out, if it doesn't change, will eventually bleed you dry. You'll eventually find yourself either having to go into debt or having to sell assets, or having significant lifestyle impacts that are very swift. This is where homelessness can happen. So it's something that you really want to get onto quick. So what I'd like to do is go through a few pointers for people who are in that situation when your income has dropped. Now, if you're not someone whose income has dropped, we are going to talk about some things for you later. But it's worth listening to this as well, because you may suddenly find yourself in a situation where your income does drop. So rather than having to worry about it, then have a think about this stuff while you're listening to this. There are some things in it for you as well. And there's nothing to say you can't save on your expenses. So worth paying attention to. Now, the first thing for people who've had a massive loss of income is, and this is going to sound trite, you are being made dumber by financial stress. It sucks, right? It's insult to injury. You've already had this decreased amount of income, and then your brain is in the back of your mind going, oh my gosh, how am I going to pay my rent? How am I going to afford this? What am I going to do? And that stress that's happening, that thinking that's happening in the background actually reduces your cognitive capacity. it's a bit wanky, doesn't it? But it basically means it's making you a bit dumber. And it's because of that stress. And stress, that happens in all sorts of situations, but they've established through some studies that financial stress is enough to cause this. And it's to the tune of about 13 IQ points on average. Though when it's really severe, it can be as much as 40 IQ points. Now, why is this important? Why am I giving you a lesson on biochemistry? It's because you're going to make worse decisions. So there's this strange belief that, and I can see why people have formed it over time, that poor people make bad decisions. But it's been shown that that's not true. People make bad decisions when they're poor. As soon as you give them money, they stop making as bad a decision. And that's because of this cognitive load. Once you take that stress away, you can start making better decisions. Now, I'm lecturing about this because if you've just had a sudden drop of income, you are probably quite stressed. You are probably panicking at times. So trying to make big decisions about your money in that circumstance, it just means that you're more likely to make mistakes. I say it to make you aware of it, okay? And not to beat yourself up later, because if you make a decision, you go, oh gosh, that was so silly. Why did I do that? Don't beat yourself up, okay? It's because you are super stressed. But what can you do knowing that? Try and carve out a bit of calm. Try whatever strategy it is that helps you release stress, whether that's a meditation, a walk, journaling, doing some exercise, whatever it is. Try and bring yourself to a physically calm state as much as you can, and then sit down and think through these decisions in a very structured way. If you can do that, you'll have a higher chance of not making mistakes, okay? So that's what we're aiming for. I get how hard this is. I get that that's going to probably sound really cruel to say to someone, just calm down, which has got like 100% failure rate. But the reason that you want to try and get to that space if you're going to make these big decisions is so that you are making the best decision that you can. So that's why you want to try and not make them in a rush. And it's why we do want to be proactive, because when you're under more stress and you rush, it's going to be a little bit harder. So that's just something to keep in mind. Now, what should you do, first of all, if you can't pay your bills that you know are coming? So you know that you've got your mortgage or you've got your rent. You know that you're going to get your power bill and your gas bill, and you know that your car registration's due. You know that your insurance is due. All these really essential things, and you know that they're coming. Your job basically is to negotiate some kind of help with those. And it does mean contacting each of those providers and trying to get some help. Now, most providers at the moment will have something about COVID relief, COVID compassionate care, COVID something related on their webpage. Go and have a look at their webpage and see if they've got a process that you can follow. If they don't have a process, you're going to have to talk to them. Now, there are 4 things you can try and do with each provider. One is get some relief. Get them to forgive part of the debt. Now, that's really hard and usually takes quite a long time. So it's not going to be highly probable, but if there are certain providers that might consider it, you could try and get them to do that. The second thing you might ask for is a discount. Get them to discount the amount that you're paying. Now, a rate reduction is the same as discount if it's debt. If you can get your interest rate down, you get a reduction, right? So that kind of a discount might be possible. More common, though, are things like a payment plan. So this is where, let's say you had a bill that was coming due for your power and it's due, at the end of the month. You call them and you say, I can't pay it all. Can I pay it over 3 months instead? So you pay the same amount, but you spread it out, okay? So a payment plan might be an option just to reduce the impact immediately. And then the last option is a deferral, which is, look, I cannot make the payment this month. I want to pay it next month instead. And banks have got a system for this at the moment where you get something called a holiday, which of course is not much of a holiday because you do eventually have to pay that money back. And that's what's really important to remember. When you go and have these negotiations, you go through these processes, anytime someone says that they're going to defer it, they're going to hold it over till the next time, you want to check whether you're being charged interest on that. And you also want to have a think about what that means. So imagine you had a 6-month holiday and then suddenly at the end of 6 months, all of those 6 months worth of mortgage payments were due. It's not going to work, right? Now, there is a very specific reason why banks are doing it that particular way. If they don't capitalize what you're not paying, so if they don't say, hey, look, you missed $6,000 worth of payments, we're going to now up your balance of your loan by $6,000, which, by the way, they're doing it in a structured way and spreading it out. So it shouldn't actually increase your payment month to month. It will increase the total you pay overall. But hopefully in 20 odd years that you can smooth that out a little bit and maybe get ahead. The reason they have to capitalize that interest is because if they don't, then suddenly your loan becomes a bad loan. Your loan falls into a different category. And that means they have to tie up more capital to mitigate against that risk according to their regulations. So when it goes from being a good loan to a bad loan, suddenly they're holding more capital. It means that it restricts their borrowing capacity. They can't lend as much to other people, and that affects the economy and has this flow-on effect. So the reason that they're capitalising that those repayments and that interest that they're missing out on while you're not paying during this holiday, which isn't a holiday. I'll keep doing the holiday because it's just the worst term. It's not actually a holiday. That means that they don't have to reclassify your loan. And so that's why they're doing it. And look, if it's better than nothing, right? It's giving you a break for that period of time. Of course, then you've got catch up to do later. It's going to get them more money. So it's an incentive if you do manage to make your repayments, but it means they can keep lending at the rates that they have been. So those are your options. That is the sort of thing you want to do like today. You want to find out when those bills are all due and start with the one that's nearest to being due and call them up if you have to, or go through their process online and try and negotiate. And don't be afraid to say, I need more help. No, this is not going to do it for me. Explain your situation. Talk to them. It is definitely worth persisting on this and trying to get those bills down, especially for those big necessities that you do rely on and you need to stay sheltered and clothed and with a full tummy. Make sure that you get onto those as quickly as possible. So the next thing to have a think about, of course, once you've negotiated these things on these known bills, is what spending can you cut? Now, this is never much fun to think about. I mean, whenever we get a pay rise, we've mentally spent it within minutes, right? And then when you tell someone you've got to cut your spending back by 20%, that's a bit harder. It takes a little bit longer to get used to. But I would like you to treat this like an experiment. Have a think of it as being an experiment for how you can decide whether something really is a want or a need. Have a think about what you're spending right now that you don't need to spend, right? And be a bit brutal about what you don't need to spend. And this is not just about, oh, hey, I can get a better subscription for my internet bills, get my internet down by $8 a month or something like that. You need to look at everything at the moment. So it's worth downloading your bank transactions, working out where you're spending the most money and seeing what you can do to reduce that. Now, treat it as an experiment for a month. Cut a bunch of stuff that you're spending on that you're kind of like, can I live without that? If after a month you really miss it, it's driving you nuts, then put it back on again. It's not that big a deal with most contracts these days. I've got a lot of them where you can just get out of their pay-as-you-go kind of ones. Check that before you do any cancellations, but treat it as an experiment. You might find out of this that suddenly you are spending money on a lot of things that you don't really need, and then you go, hey, I don't actually need that anymore, and look, I've got this extra money, and how wonderful would that be if you can put that towards your financial independence? So treat it as an experiment. Start with the biggest items. Start like everything is up for grabs when your income has dropped. You need to look across the board at what you're spending your money on, and put in place those actions to reduce those things, whether it's cancelling subscriptions, whether it's possibly even freezing your credit card. I've seen people do this, put the credit card in a glass and stick it in the freezer, and that way if there's an emergency, you can get it out. Tactics like that work. See what you can do to cut your costs dramatically. And that's your aim. You're trying to get your costs down. The reason for that is we're trying to avoid debt, right? We want to make sure we're avoiding having to go into debt to cover this short-term loss. And so another aspect that you might consider if you're looking at that is, and you would have heard about, the early superannuation access. Now, this is quite a contentious topic at the moment. And it's something that's always existed. There's always been a capacity for people to withdraw some of their superannuation. And it's been for reasons of hardship. So, you're homeless or you're going to be homeless. If you've got a terminal illness, if you've got someone who needs desperate help, those kinds of things. There's always been those criteria. They've been quite stringent. It's been hard to prove that you needed to get that super hardship access, but they have let you do it up to $10,000. It's been there forever. Forever, as long as superannuation's been around. 1992, by the way. So that's existed for a while. What they've done is made it easier, and they've changed the criteria to say, okay, if your income has dropped by a certain proportion and if you don't have any buffer and all those kinds of things, you only have to meet one of the three criteria, and they're allowing you to do it twice, to do it in this financial year, so up to 30 June 2020, and then between 1 June and 24 September 2020. So that's the next financial year. So theoretically, you could withdraw 20 grand. The average withdrawal at the moment has been $8,000, and I think there's been something, last time I looked at the stats, it was 456,000 payments had been made by last Thursday, 600,000 claims. They're processing them quickly, and there is a regulation that once that gets approved, the funds have got to be with you within 5 days. That's got a big impact on the economy. You can imagine the superannuation funds having to liberate, nearly $4 billion in that last round. Means they're selling assets when their prices are down. So it's not great news for super. Right. You might do it if you were worried about ending up in debt. So when we take debt out, whether that is using a credit card, a personal loan, extending our mortgage, whether we are using a payday loan, oh, please stay away from payday loans, all those things that we might use to plug a short-term gap, you're guaranteed to be paying interest on those. You will definitely be paying interest on your credit card. You will definitely be paying interest on a payday loan. So you've got this guaranteed interest if you go to debt but leave your money in super. If you take the money out of super, you definitely won't have to pay that interest. So that's what you're kind of mitigating against there. You're trying to keep yourself out of that downward debt spiral. But what you might be forfeiting is what that is worth in the future. So we look at $10,000 and think, oh, it's 10 grand now, that'll get me through. But in the future, depending on your age and on super returns, it could be much more. So if you are young, under 30, you've got 40 plus years before you're likely to be looking at that superannuation. And 10 grand can turn into a couple of $100,000. Yes, a lot of money. And that's, 5% returns compounded. So it might sound high right now, but over the case of 30 to 40 years, it's probably going to happen. At some point, we're going to see everything turn around. It just might take a while. We don't know how long. So when you take that $10,000 out, you've got to think of it as I'm giving up 200 odd grand in the future, or it might only be 50 grand, who knows, but it's a lot more than what it's worth right now. You're giving up that future cash flow. So you've really got to be sure that you need it and that you don't have a better alternative before you take that superannuation out. So think very carefully about that lost opportunity cost. There is this economic question, of course, which is when superannuation funds are forced to sell heaps of assets in order to give us our cash, that it forces everything down and we all suffer. So there's a macroeconomic argument for saying do the right thing and don't pull your money out of super as well. But it's so much of a personal choice there. You've got to take that in the context of what you're doing, what reserves you have. And I do wonder if 10 grand is what it takes to have alleviate that mental stress and for you to be able to think clearly about your money, then it might be worth it just purely from an emotional point of view, if not a financial point of view. But think very carefully before you do it. Now, if you're in the situation where you're looking at taking your money out of super, you are likely to be qualifying for help from a financial counsellor. Financial counsellors are not for profit. They don't charge you any money. They cannot sell you a financial product. They're not allowed to even promote books. They're not allowed to do anything like that. They cannot have any association with making profit out of their financial advice, which makes them completely unbiased and independent, and they can give you advice and guidance. Now, an interesting thing has happened recently that demand for financial counsellors has dropped. Usually, under normal circumstances, you might wait 3 to 6 months to be able to chat to an individual. But at the moment, for some reason, I guess because everybody's kind of, getting their money from Centrelink or things like that, that their demand has dropped. So your chances of getting to talk to a financial counsellor if you call today are actually better than they were pre-coronavirus, which is pretty fascinating. But it's definitely worth talking to someone like that. If you are wondering whether to take the super out or not, then someone like that who is unbiased will help you assess your financial situation and help you make the right choice. If you call the superannuation fund, they're probably going to be like, please don't take your money out. Look at every other option. And you talk to a real estate agent about not being able to pay rent, they'll be like, go and have a look at your superannuation. So those people have all got vested interest in your decision. Try and find an unbiased party if you can. And financial counsellors, if you're in that situation of you're actually looking at that kind of hardship clause, you probably qualify for their support. So go and have a look at that as an option, or you can consider, of course, looking for a financial advisor or planner who can help you make a decision about what's going to work best for you. But it is very much an individual one, so please think about it carefully. If you do decide to take the money out, then think about how you might get that money back in there in the next couple of years. That's worth considering as well. All right, the fourth thing you might be looking at if you are lucky enough to have investments is that you might find yourself feeling like you need to sell some investments to cover this shortfall. So as an alternative to taking on debt or to taking money out of super, you might consider selling some shares, some bonds. You might consider breaking a term deposit early, those kinds of things. Now, one of the things that's quite depressing, of course, when we have a down economy is that you might find you're selling things below what you paid for them. You might find you're selling them below what you believe the intrinsic value is. So you'd want to think very carefully about that. And it's very much about the assets that you have. The thing to remember, of course, is that selling shares can be done in a matter of days. You'll have cash within a few days, depending on the time to settlement. It's about the price you're willing to accept for them. Same for bonds. With the term deposits, it's about forfeiting interest, right? The thing that takes a long time to liberate cash from is property. So if getting money out of your property is your backup plan, you want to be thinking about that well in advance. You would be breaking records if you were able to get a sale of a property through within 30 days of deciding you wanted to list it. People do it, but it's not easy. So if where a lot of your money is property, you need to think about whether you need to be proactive about that sooner, whether that's a refinancing thing, whether that's about a subdivision, or whether that's about selling the property. You need to get on that sooner rather than later. So just have a think about that, and also think about the fact that you're locking in your losses. You actually don't make a loss until you sell. So if you can limp through until things recover, if you believe they're going to recover, then that might be a better option. If you don't think things are going to recover and it's just going to keep going down forever, then you might look at trying to sell. Very much an opinion-based one there, guys. My crystal ball won't be able to tell you about that. So that's for people who have got a big loss of income quickly. What do you do to negotiate with the people who you owe money to that you're going to have to pay soon? Cutting spending, looking at your early super access, and then possibly looking at selling investments. There is another group of people, and I hope it's a lot of you, that have some income still, and that maybe you've had a small loss of income, or maybe your job's just the same. Maybe you're working from home now. Maybe you've actually had an increase in demand. And I think about businesses that produce hand sanitizer are probably pretty happy right now. Places like that. There are people out there who are still earning money. Please don't feel guilty about that. We need you to keep earning money because we need you to keep spending money and investing money, keep the economy going. And the more of us that are working and earning an income, the better the economy is going to be as a whole. So it's not a bad thing. Don't beat yourself up and don't feel guilty about it. But what you might want to do is have a think about your circumstances. The plan that you had before coronavirus might need some tweaking now. Okay, because I don't think any of us expected this kind of a lockdown. I sure didn't have it in my plan. I wish I could edit my book just to add one dot point now in the income drop risk management section, which is what if a global pandemic locks down the entire country or the entire globe. But I haven't obviously been able to do that. It's the joys of printed text. You can't edit it. But what you want to think about, of course, is some of your risk management stuff. That's probably the highest priority. So what risks did you know were coming before? And then do you need to tweak anything in your plan to deal with those risks? You also might be thinking about, hey, assets are on sale right now. Share prices are down. We think property might go down. Bonds look pretty good. What could you buy? So we'll talk about that as well. But again, this is about headspace. It's a bit different for someone who still has an income. What you don't want to do is get so excited that you rush and make an emotional decision because you're like, oh, I want to buy gold or or I want to buy a particular share if you haven't got a very structured plan around it. So it's exciting. It's great times. The big drop, the sudden drop has already happened. And there's questions now about whether everything else will be very slow either direction. So you can probably feel less rush now. Try to be structured about what you do so that you don't make mistakes. So what are the things that you might be looking at if you still have an income? First of all, I would be looking at the size of my buffer. Now, what's a buffer? It's a lovely comfy cushion of savings that's there to get you through periods of low income. So anyone who has lost their income or seen it reduce that has some buffer is able to draw on those savings. And that's what they're there for. They're there for emergencies. I think this qualifies as an emergency. The idea of having that buffer is that you can maintain some, payment of your cost of living expenses while you're looking for other sources of income. And generally that would be about, the size of your buffer would be about what your obligations are. So someone who lives at home with mum and dad and studies probably only needs 1 or 2 months of living costs in their buffer fund because they've got, a pretty fail-safe plan. If you have got kids and a mortgage, you might want a year's worth of income or a year's worth of your expenses in your savings account as cash so that it's ready there to go, because you might think, gee, it might take me 12 months to recover. It might take me 12 months to find my next job, and you can't walk away from your mortgage that quickly. Or you can, if you do the holiday thing, you just end up paying for it later. So the size of your buffer will be about your personal circumstances and how comfortable you are. And it's about having it in cash so it's readily accessible. You want to have a think about whether your buffer is big enough right now. Do you want it to be a bit bigger? Do you want a little bit more in there because you're a bit more worried about what would happen? And even if you haven't had an impact on your income yet, is it conceivable that there might be an impact on your income? I think the projections are looking at possibly 10% unemployment. That's quite high. And we don't know what the flow-in effects of that are going to be. So just on an average sense, your chances of becoming unemployed have probably gone up this year. So you might think about the fact that it might be harder to get a job than it was, say, in 2019. So based on that, have a think about whether you need a bigger buffer fund. And if you do need a bigger buffer fund, then increase your savings and try and build that buffer fund up as your first priority. Now, I think of this as sleep well stuff. Knowing that you've got that buffer means that, hey, like an emergency strikes, you go, that's okay. I'm going to be able to feed myself for the next 6 months. We're going to be able to pay the mortgage for the next 6 months. That's enough time for you to come up with a plan. And it's that sleep well factor that's going to keep your stress low and going to mean that you can make good decisions. And that's why we want to make sure we've got that buffer and it's the right size for us. So have a look at your current buffer fund and have a think about whether you want to make it any bigger. Now, the next thing I recommend doing, and this is like a one-off exercise, that you carve out now and you sit down and think about all the things that could go wrong. Okay, so hey, this is a brave new world. I could lose my job. The business I work for could close down. My industry could be wiped out indefinitely. What would you do if you do lose your job? If that does happen to you, if that bad thing does happen? Write down what you would do. So I would call my bank to get my mortgage reduced. I would sell this particular asset to do that. I would cancel this insurance, or I would negotiate this reduction. Write that down. Have it written down as a plan, and that is your anti-worry plan, because you don't need to worry now about these things happening. When they happen, you pull out the plan and you execute the plan. So this is, again, about this mental stress. So create that plan, create that rainy day. What would I do if these things happened? And often you'll think of things that you're like, oh, well, I forgot that I had this cash sitting over here, or I've got these shares that I could sell, or, hey, you know what? I know my bank manager's number, and oh, look at that. I could probably negotiate my interest rate down right now. There are things like that you can think about that you could put into action now, but at least you've got them written down. There are also things that you might trigger that you go, oh, I better check that. Because there are things like insurance that you can't apply after the thing has happened. You have to have it in place before. So once you've been through that action plan of what you would do to respond, you might go, hey, if I had something in particular, some insurance here or a bigger buffer fund or whatever it might be, then you can go out and get those in place beforehand. And that's just a little bit less stress for you. Okay, so that's something for you to consider. Writing that contingency plan down, put it somewhere safe, have it ready to go, and then you don't have to think about it. You don't have to worry. All right. I get a lot of questions about superannuation from people who are still getting an income. So there's a couple that have come up. First one was, should I switch my superannuation to cash? So you might have had it invested in a high growth or a conservative mix, or you might have picked one particular exchange traded fund. There's lots of options within super these days. And this talks mostly to people who have got, who are with a super company, not self-managed super. Self-managed super is a different kettle. It's probably too late to switch to cash to reduce those losses, unless you think that the economy is going to continue to go down substantially over the next 6 to 12 months. The drop was in March. The drop was around mid-March. It went, everything dropped 20% overnight. Yes, it's come back a little bit, but it is still well down. And it's the fastest drop we've seen. We haven't seen one of this speed before and of this magnitude before. So the window was really small for doing that. So if you haven't changed your superannuation mix across, which you should be able to do for free on your online super, you may have missed that boat. Okay, so your question now is, do you think it's going to drop substantially over the next few months? You may look at changing your super mix. Maybe you'd like to go with something more cash weighted or more conservative. But remember that when you change, that's when you lock in your losses. Okay, so how are you going to feel if in 6 months' time you've changed to a more conservative, more cash-heavy mix, and it turns out you overreacted and super's gone back up 20% from where it is now, and you missed out on that? Are you going to kick yourself, or are you going to think, hey, look, it was worth it? And the answer to that question is it will guide you, because it's a personal one. How do you think you'd respond? Some people would rather know they lost X amount and be happy than think, oh, well, I lost that, but we weren't sure it was going to happen. So that's a personal choice, and one you need to decide for yourself. Just, I guess, be aware that the sudden drop came. It's now a question of whether there's going to be a slower and or more substantial decline as we see what plays out in the economy in the next 6 months. And that, again, pull out your crystal ball. Tell me what you think. Or maybe you guys have got one that works. So that's the first question. Is it too late to switch to cash or change it around? I guess the other thing to be aware of that is that most online super, it's a requirement that they're allowed to let you change your mix online. And I think you're supposed to be allowed to do it once a month. Check with your super fund, but it shouldn't charge you anything. There shouldn't be transaction costs and stuff like that. It should be just a straight changeover and no fees. So just go and check with that. The next thing I get asked about is salary sacrificing. So some of you wonderful people are salary sacrificing into superannuation. And if you're close to retirement, that's quite a smart way to reduce your tax. So I've been asked a couple of questions about, is it worth still doing that? Is that a waste of my money? Could I be putting it elsewhere? And that's a great question. Again, it's a personal one. So if you're salary sacrificing into superannuation above your minimum compulsory amount that you're paying from your employer's paying at the moment, there's a couple of ways to think of it. First of all, if prices of everything in the superannuation fund have gone down, then you're getting better bang for your buck. You know, the $500 that you put in December 2019 bought you X amount of units. Right now it's buying you X plus 20%, right? So you're actually getting cheaper value. So in fact, it might be better having the money in super. You might be getting more bang for your buck. And that is dependent on what you've invested in, dependent on how much you're putting in, and depending on, you know, how that particular fund performs. But you can think of it, if you're happy with a long-term one, and particularly if you've got a long time until you're going to pull money out of super, the compounding effect means that you're going to get that sort of extra boost. So you can think of it that way. I often, when people are asking me about whether they should put extra money in super, I need you to think about this in your context, and you've got to be brutally honest here. If the money didn't go into super, what would you do with it? So if it goes into super, we know it's going to get invested, right? It's going to be sitting there. It's going to be gathering momentum. It's going to be compounding up, and it will be worth more money, we hope, by the time we retire. And the further away retirement is, the more likely that is, because we've got all this extra time to catch up this growth. People who are retiring in the next few years, a bit more iffy. So if the money was instead in your pocket, and you probably pay a bit more tax, so, you know, the $500, depending on what your tax rate is, might only be $400 in your pocket, you know, depending on what it is. What would you do with that extra money? Would you spend it? Would you put it into your buffer fund? Is that how you would top up your buffer? Or would you invest it in something else? Now, if you're likely to just spend it frivolously, you might find you're better off leaving it in super. If you're doing it for the purposes of building up your buffer fund, or you've got a particular investment strategy you want to do and you want that extra money for investing, then okay, if you're investing or topping up your buffer fund, then you're trying to boost your current financial situation, not your retirement financial situation. So maybe it makes more sense then to have that money in your pocket, even if you're going to pay a bit more tax. But again, this has got to be a highly personal question. So you've got to have a think about what you're going to do, be brutally honest with yourself, and decide whether you're going to need it. Now, if you're avoiding debt, if it's pulling out, same as with the super, if you're pulling out that extra money so that you don't have to go into debt, we know the debt interest is guaranteed and you're going to have to pay it now. The future gains aren't guaranteed. So you've got to trade that off. Personal question, but if you know you're going to spend it frivolously, if it's just going to go towards more stuff that you're going to get delivered to your door that's not actually essential, you'd want to think twice about cancelling it. Now, of course, one of my favourite topics, assets are at sale right now. Share prices are cheap. And sorry that I look so excited about this. People who are who don't have much income at the moment will be cursing me. Sorry, guys. But those of us that do have some cash sitting around are looking at those prices and thinking, wow, I can get some of these amazing companies or these exchange traded funds or listed investments or all sorts of stuff. I can get gold, you know, like all sorts of things are happening at the moment. What can you get that's on sale? So let's have a little think about what you might be thinking about if that's exciting you at the moment. Look, if you are thinking about buying assets, the way you've got to think about the cash that's going into those assets is that cash is gone for like 5+ years, maybe 10+ years at least. Any money that you put in there, you've got to think that it's going to be locked away. Now, regardless of your strategy, regardless of whether you're thinking, oh, well, I'll buy a property and flip it in a year, or I'm going to buy this share for 6 months and it goes, we don't know what the economy is going to do. We don't know what that asset's going to do. We can guess, but we don't have a surety. Something might change. You might have the best flipping idea for your house ever, but then suddenly the market plummets and you can't sell it. Okay, so or you might find that you've got this particular share trading strategy, but then something changes with the particular company or the fund or the market that we didn't foresee, and suddenly you'd lose money if you exit. So it's really important that when you're thinking about investing, you're thinking about, look, this money is gone. So don't do it with money that you're going to need to pay your rent, to pay for food. Make sure you've got your buffer fund full, and then look beyond that. If you've got money in excess of what you consider your full buffer fund, then you would think about assets, but don't get ahead of yourself. I know it's tempting. I know it's really tempting when they look like they're on sale, but the worst thing that can happen is you take like half your buffer fund, you go and buy these shares, and then the market doesn't pick up, and suddenly you need the money to pay for rent. And so you have to sell those shares cheaper than you bought them, and you lose money. And what a kick in the teeth that would be, right? We don't need that right now. So make sure that you're very I would say conservative in that estimate. I would say err towards the side of caution. The other thing, of course, that you want to remember is that you cannot pick the bottom, okay? Most of us would love to think that you can pick the bottom of the market. You can go, oh, that's the lowest share price. And, people who bought Commonwealth Bank at $26, people who bought BHP at $14, like, but I picked the bottom. Maybe you can. Very unlikely, okay? Very, very unlikely that you will pick the bottom of a market, whether it's a property price, whether it's a share price, a bond price. Very unlikely that you will get the exact moment of the bottom. We never really know what the bottom is until hindsight, right? So accept that you are unlikely to be able to pick the bottom and then decide on what you're going to do. There are two popular strategies for this. The first one is something called dollar cost averaging, DCA. So dollar cost averaging means you buy no matter what happens, okay? So every month you buy this particular investment. So usually people are talking about shares with dollar cost averaging. And you just average the price. So you buy it when it's $5, you buy it when it's $4, you buy it when it's $3, and you're putting $500 each time. It just means that you got more shares when it was $3 than you did when it was $5. But you believe so much in that particular share, that particular fund, that particular company that you don't mind. And you're just averaging your price, okay? So that's this idea of I believe philosophically that this particular asset is worth buying. So I am going to buy it no matter what the price is, or up to a certain limit, and keep going. And then you average. And then the idea is you're not trying to pick the bottom. You keep buying all the way through the cycle. So if it turns out that this is the bottom, then hey, you might have bought some at the bottom, but you bought some as it was going down, and then you buy some as it's going up. And again, we don't know how long that could be. It might be going down for a long time. But if you believe fundamentally in the value of the asset, then you just say, well, I got more of them for less. This is a bargain, right? And then you average the cost over that holding. So that's dollar cost averaging. That's that idea of I don't know what's going to happen with the market, so I buy progressively. Another alternative is to wait until you feel it's turned. So rather than trying to pick the bottom and buy on this side, waiting until you think it's picked up a bit on the other side, and then buying at that point. Believing that you would have to believe that the economy is now on an upswing and the price is going to go up and this particular thing that you're buying is improving. But the fact that it's turned is important. Now, this is fraught with danger as well because, of course, transitioning from bear and bull markets, we see a lot of volatility in bear markets. Things go up and down a lot. And even the ASX has looked pretty good over the last few weeks. We've had some decent gains. There's still been some ups and downs, but it's looked like a turning point. So you'd want to ask your personal opinion about whether you think that this is a sustained upswing or not. And then, of course, you have these feelings of, but I could have got it for, $3 a share back then, and now I've got to pay $3.50. You've got to be very aware of what your mental state's going to be around that, whether you're going to say to yourself, I don't want to buy it now, I'll wait for it to dip again, and then you miss out altogether. And that is why I guess a lot of people who think of set and forget investing tend towards more that dollar cost averaging, this idea that I'll just keep buying because you're buying for a fundamental philosophical belief that whatever you're buying is going to continue to increase and it represents good value, whichever price it is, and therefore you keep buying. And it just means you take that judgment call out of it and that emotion out of it. But that said, it doesn't work for everybody. And so there will be people who aren't buying shares right now because they are holding on because they think the value is going to drop further. And that's, again, about what you think might be happening, consulting your crystal ball. So have a think about that. Are you going to try and pick the bottom? Are you just going to average on the way down? Or are you going to wait for a turning point? Okay, so picking the bottom is unlikely, but if you manage it, good for you. You'd be one in a million, almost literally. The other thing to think about, of course, when you're investing is you make the money when you buy. The price you pay for the asset determines how much money you're going to make in the future. Because when you're selling, it's about finding a buyer. For a property, finding a buyer is much harder, right? Because it's a limited pool. When you're selling a share, it's a lot more straightforward because you're selling to a market and there's a share price. But that price is not really controlled by you. You control the bit that you can control is how much you're willing to pay for it. So you want to be very sure that the price you're paying for the asset is the one that you want. So think very carefully about looking for quality, undervalued assets. So things that you know are going to be fundamentally good assets that you are happy to have, and then things that are on sale because this is a great opportunity to get them on sale. So think about that. The other thing to think about, of course, is growth and yield. There is very typically people focus on growth. We're looking at the average share price over time. But if you are interested in financial independence and you're interested in any kind of early retirement, or I like to think of it as being time rich, this choice that you get when you suddenly get an income from your assets, then you need to also be thinking about the yield you get. So yield is the income you earn from the asset. For cash, it's the interest you get paid. It's the thank you that the bank gives you, says, oh, thanks for letting us have your money and here's some interest. When it's bonds, it's coupons that you get paid, and then the face value just gets returned later. You care about the coupons. When it's a share, it's the dividends. So that's that way of that company saying, thank you for investing in our company. Here's some of a share of our profits. With, of course, property, it's rent. So you need to think about both of those things if you're interested in early financial independence, if you want to get there before retirement age. So make sure you understand both of those things. Now, I've got a case study for you to sort of think about this. I had a lovely reader question. Hi, Evelyn. Nice to see you. Hope you're on there. And Evelyn is 19 years old and she's looking at buying an apartment. She's currently living at home with mum and dad, I assume. She's at home and she'd like to move out after quarantining ends, which is a pretty common sentiment, I think, at 19 years old. I can certainly relate. And she's looking at Taringa, which is quite extraordinary because that's the suburb in Queensland where I bought my first apartment when I was 19. So this feels like a bit of a sliding doors moment. And Evelyn wrote me a question because she was interested in looking at a unit, which is the same thing I did. And she would love to buy a 3-bedroom, 2-bathroom, a 3x2, but realistically thinks she can probably afford a 2-bedroom, 1-bathroom property. She's looking at something under $330,000 and interested in using the first homeowners grant, which is $15,000. So that's quite significant, right? Like $15,000 is nearly 5% of 300 grand. So that's 330 grand. So that's a pretty big whack of help. And what Evelyn was curious about, because she's recognizing, of course, it's going to take a long time to pay off. The mortgage is going to be 20 plus years. Boarder, rent out the second room. So, she's the owner, occupier, but rents out a second room with a boarder. Should she rent out the full apartment so she could rent it out to 2 people or to 1 person and they pay for the whole apartment and she either stays at home or the other option is that she rents somewhere else cheaper. So a few things if you're thinking about something like this. First of all, the conditions on the first homeowners grant, you'd want to check that carefully. I used the first homeowners grant in 2001. It's been a while, but when I used it, you had to live in the property to qualify because it was homeowner grant, not investor. So you might find there's you can all hear me and it's working okay. Is it reconnecting? Just testing. I'll test it's working. Testing. Sorry. Is that working? It seems to be working. Okay, I'll keep going. Sorry about that. I had someone, this is the joys of using your phone. Someone's called me, bless their cotton socks. It's interrupted my internet connection. Even though I had do not disturb on there, I've done all the right things. Okay, so first homeowner grant. Do you need to qualify for that by having lived in it? Make sure you check that first. Second thing is there's actually an incentive to live in a property at some point, and at the beginning is a great place to do that because it sets the tone of the property for tax purposes. And that is capital gains tax. Now, this is the existing regulations. It may change at any time, so you do want to check this, okay? At the moment, the way the capital gains tax works is if you sell the property within 6 years of moving out of it, so you live in it for a year and you sell it in year 7, and it makes a profit, and it was treated as your principal place of residence, and you didn't have another principal place of residence in that period that you sold, then it is exempt from capital gains tax. Now, why that is attractive is, let's say that you make hundreds of thousands of dollars on the sale of a property, or even if it's 50 grand, if you make that profit and it's an investment, half of that profit, so if you've made a profit of 50 grand, 25 grand is taxed at your marginal rate. Now, if that's a year when you're paying, you're in one of the higher tax brackets, that means you give away a lot of that money, right? And it goes to the government and they do the right thing with it. But it is an incentive if you're interested in minimizing your tax, that by living in it first, even if you live in it for a year, get your first homeowners grant, it counts as your principal place of residence, then you move out. If you sell it 6 years later, and it's the only principal place of residence that you own, then you're exempt from that capital gains tax. Now, At the end of that 6 years, then you want to get a valuation, because then any growth after that you would be paying tax on, because it's an investment by that point. There's a lot of nitty-gritty in here. This is just a general thing, but that is actually an incentive to make it your principal place of residence first, which is why both of those reasons, the first homeowners grant and your capital gains, are reasons why you might want to first live in the apartment, even if you rent out a room, but you want to actually really live there. And that's actually the strategy that I used with my first apartment. I lived in it for 2 years and I rented out the second room. The other two alternatives that you talked about, which was about renting out the apartment as a whole and either staying at home or renting somewhere else cheaper, that's really about the differences in price. And so, look, when I did this, my mortgage was $110 a week and I rented out the second room for $90 a week and then added utilities to that. You know, my difference was maybe $40 a week when you took the utilities out. So and the rent for a room, for me to rent a room in a share house with 3 other people at the time, was $100 a week. So it was actually cheaper for me to live in it than it was for me to rent another room. So it made sense financially. You'll need to have a look at how much those rent for. Now, I've had a look at Taringa recently because, of course, I'm an investor in the area. I still have that first property. And there are properties there that are selling for under $300,000. I saw one 2-bedroom, 1-bathroom that was $250,000. I can imagine that you would probably be getting, you know, somewhere in the order of $250 to $280 a week rent for something like that. So you'd have to have a think about whether you can rent something else much more cheaply, what state the apartment is in, and what you would likely to achieve as rent if you rent it out as a whole, or whether you'd rather have a border. So it is a question of the individual property. It's a question of how much you've got as a deposit and therefore what your mortgage will be. The good news, of course, is that with low interest rates, you'd be aiming for a 2.09, because they generally will fix your interest rate in the first year that you sign up for a mortgage. So you'd be aiming for something like low 2s. To get a mortgage, which is going to put your interest rate much lower, makes your repayments a lot lower. So my interest rate, I thought it was amazing that I got a 5.1 interest rate with that first property, but this is going to be much more impressive. So you'd have to do the maths based on how much you'd saved, how much you'd need to borrow, what your interest rate is, work out your mortgage, work out what your difference is, and run those scenarios. I do have a spreadsheet where you can play around with that kind of stuff, which is on selling investment property, and you can have a look at the maths in that. So I'll post the link for that later. Have a look at that, Evelyn. But yeah, you really need to start thinking about as well how much you can save, what your deposit can be. And don't forget to, if you're looking at an apartment, look at things like body corporate. How much is the body corporate for the complex that you're looking in? Because if it's got something like a pool, which has got high maintenance, that body corporate will be higher. Have a look at what your insurance and your rates would be. Remember to account for those costs as well. And then have a decision about it. The tax incentives for a negatively geared property, treat them as a bonus. That's my suggestion, because if you treat that as the reason for having the apartment, then you get this tax reduction. Then if they repeal the law, which is possible, they might get rid of negative gearing rules, then suddenly, you're having to reach into your pocket and not getting any of the benefit for it. So make sure you keep that in mind when you're assessing this. Work out what your deposit is, find out what your first homeowner grant rules are, see what kind of a loan you could get, and then do the difference between what if I rented a room in a share house or a unit by myself versus what I would get if I rented this out whole. And you can look online at realestate.com.au to see comparable places and to have a look at what's for sale and what's for rent. I hope that helps, Evelyn. I hope you find that useful. Okay, so that is all the topic I had covered. We have stuck within the hour, which is very exciting. Now, I don't know if I've missed anything, but I can't see any chat coming through. No one's actually sent me anything. Let me just see. Yeah, no one sent me any questions. So I'm going to assume that everybody has no questions. And say thank you very much for coming along to this live stream. I really appreciate it. I would love to hear your feedback. We would love to hear if you like these lunch and learns. Do you want to use them? Are you happy with YouTube? Would you prefer them in Facebook? If you want to comment on this later, on this particular video, send us an email, anything like that. Oh, Gree, yep. Thank you, Gree, just for letting me know that we got one. Excellent, it worked. Let us know. We would love to know what's working for you. We're trying to do this to help you guys. We're trying to support our community and provide wonderful information. And we'll have fantastic people doing these lunch and learns over the next few months while we're all still stuck at home, which is where I am right now. So do let us know what you want, what you need. Let us know if we can help you. And please remember to join WiTWA if you haven't already. Jump on our mailing list. You have to go and check check out the website. It is amazing. And since Gree's been listening, Gree, thank you. Awesome job. And the whole team who's worked on that. There's been a massive group of people that have made our website look extraordinary. Go and check it out. Don't forget, we got the awards coming up soon. Stay involved in the community and keep connected. Let us know how we can help you. Thanks very much for listening. I'm Lacey Filipich from Women in Technology WA, and wishing you a wonderful day. Cheers. Bye.